Well, this is the
Good.
analogy that you have to put forward in front of people. They're giving you that 0.01% interest. But if you go to the bank and say, I have a need for a loan, they're going to charge you 7%. So they're only giving you 0.01. But if you need access to funding, they're going to charge you 7%. That
Who's making that
arbitrage
spread?
is in
Mm-hmm.
their favor. It's
Mm-hmm.
always going to be in your favor. So this is to say, well, rather than banking on Bank of America, right? I want to have the Pendergrass Family Bank.
Welcome to the Share the Wealth Show, where minority professionals can learn to escape the racial wealth gap and catapult themselves into abundance. Your host, Nicole Pendergrass, grew her net worth from being negative to multiple six figures. Join her on her investigative mission to expose secret strategies of the wealthy so we can all have the tools needed to build the life and legacy we were created to possess. Now it's time for the show.
Hey guys, so we're back again. This is the second part of the episode with today's guest. I need you, if you have not heard part one, go back to the previous episode and listen to that first, and then come back and join us here today. You need to hear the whole conversation. This is why we split into two parts. There's so many nuggets. It's so juicy. Go back and listen to the first part. So if you are trying to invest and live an abundant lifestyle in your retirement, people they think they were going to retire and be able to travel the world and live on the beach and do whatever they want, because now they are getting funded, I guess, by their retirement. I mean, pension is kind of a thing of the past. Some people still will get pensions, some now, the next generations will not. But in any case, you're not really still living at the level that you think you're going to, especially with inflation. Like if you're thinking, oh, well, I'm going to get $10,000 a month in my pension. Yeah, depending on what you're living at and at the level you're living now. But what about in 50 years when you finally retire? What's $10,000 a month gonna buy you, right? It's not gonna give you the lifestyle you probably are assuming, or that you in your head would think that you want when you get to that retirement age. So that's definitely something else to
I don't
consider.
think that people are forecasting a degradation in their lifestyle when they retire.
No.
And that plan of leveraging your 401k means that, right? So even if you were to take out your distributions at 59 and a half, which is what you have when it comes to your 401k, if you're still working, that's going to be additional income that you're going to be taxed on. So if you go to the book 401 Chaos, he puts forward an argument that it is best not to invest in your 401k for a couple of simple reasons. One, you can't have access to those resources until 59 and a half. If you need to access or tap into those resources, you can take a loan, right? But if you somehow terminate from that employer within a certain time frame, that loan must be paid back immediately. Otherwise, it's going to be an early distribution. And with early distribution, there are penalties that go along with that at the same time. But I believe the chief argument that he put forward inside of the book is that although you are deferring paying taxes on a 401k, right? That 401k, if you were to take a distribution, will be taxed at your income level, whatever your W-2 level is, but it might take it even higher. So that's probably going to be 21 and above, right? However, if you were to take a distribution from your insurance policy or a loan from your insurance policy, that is typically going to be between, well, whatever the rate is at the insurance company, but that's around 4 or 5%. And Elon Musk just showed a reason why you do this is because he didn't sell his Tesla shares. He took out a loan against his Tesla shares. And that's what our community needs to learn how to do, is leverage those assets while you are still in control of that asset. Too often, the family home gets sold when grandma is no longer with us, right? That house should stay in, because that house, once it's paid off, it's a source of cash that can be leveraged to grow. So 401k, he basically put forward the argument that you would pay taxes at plus 25% if you were to take an early distribution. And the reason why he's saying, if you had invested that money, right, capital gains is, if you have the asset held for longer than 1 year, is 15%. So you now got to compare 25% versus versus 15%. So he puts forward the whole entire argument, and then it starts to make sense as to why you might want to go over here versus going over there. At the end of the day, it may not be right for that individual, and that's okay, right? But for those who understand it, and it falls into their plan for where they want to go, then come on, there's an opportunity to come along with us on this journey, because we find value in it.
Mm-hmm. And I understand, and I love it. Because I have my own bank on yourself type of life insurance policy. And the reason that I opened it, and I thought that it was different and made sense than the normal traditional way a whole life policy is normally set up, is because in the way that you set it up and the type of company you need to look at, your cash value accumulates much faster than the traditional manner. If that, correct me when I'm saying anything that's wrong. But because and you can supercharge, let's say you happen to have like your tax refund, you could take that and put it into the policy and charge it up a little bit, but you could still like now turn right back around, and when you need a loan for something, take that out. So it's not just like, let's say, to me the difference is, let's say I got a big tax refund. Let's say I have like a $5,000 and I put it in my bank account, my savings. Then I needed money for something, I go to my savings and I just pull it out and I'm just taking it out.
Yes.
But one, we know the bank is not giving you any kind of return on that, like that investment for the bank.
0.01%. We pulled it up the other day.
Oh God.
And I'm not trying to put
Yeah.
Bank of America on Front Street, but if you had up to $50,000 in a savings account, they would give you 0.01%. Up to between a greater than $50,000, they were giving you 0.02%. Understanding, if you were to put money into that account, I would tell you, don't do it. Go to Las Vegas and party like a rock star, because inflation at this point in time is still carrying over 4 to 5%. So if you're getting this little bit, but if inflation is eroding it, you might as well go and have a good time. Life is short. Go and have a good time. But I would
Or
say,
at least take 4 to 5% out of your savings and go and gamble that, because that's what you're losing anyway with inflation.
well, this is the analogy that you have to put forward in front of people. They're giving you that 0.01% interest. But if you go to the bank and say, I have a need for a loan, they're going to charge you 7%. So they're only giving you 0.01. But if you need access to funding, they're going to charge you 7%. That arbitrage is in their favor. It's always going to be in your favor. So this is to say, well, rather than banking on Bank of America, right, I want to have the Pendergrass Family Bank, right? And you set up rules around that family bank with the family on how those funds will be used, right? So this way you're having that conversation with your daughters and you're saying, this is how we use this bank. One of the points that you talked about, because we got into this and we used a third party. That third party didn't set us up correctly. After 3 years of funding our bank, we were like, this thing is not growing cash value. What is the problem? That person had set us up with a policy that grew its death benefit at the expense of its cash value. So one of the points that we need to touch upon today is deciding on what type of insurance company you have to use. There's a mutual company, and then there's a shareholder company. You just have to X out shareholder company because the dividends at a shareholder company are paid to the stockholders. With a mutual company, the dividend is paid to the policy holders.
To build wealth with real estate? Are you all tapped out on YouTube University and ready to get help tailored to your specific situation and goals? Have you always known that you are a little different from the crowd, that you never liked following the status quo, and that you're just tired of living in mediocrity? You want to build wealth on your own terms outside of Wall Street? Well, then maybe the Microfamily Mavericks mentorship program can help with that. It's a community where I handhold you through the process of buying your first small commercial multifamily building, because not everyone is ready for 100 units out the gate. Why multifamily? Because it gives your rental income a hedge against vacancy. Imagine what happens when your single family rental tenant leaves, right? And why commercial 5+ units? Because you have much more control over increasing the building's value in the commercial space, and then in turn, increasing your own net worth. Starting small is a stepping stone to so much more, because then you can tap that equity and buy another building and another and another, and you get the point. So increasing your cash flow and your ability to be job optional along the way. It's all a part of the journey. So if you think big, but you want to start small, and if you know multifamily real estate is the way for you to open the door to building a life of freedom, abundance, and legacy, but you just need someone to guide you step by step, and you want to be surrounded by other people on the same journey, doing the same thing, then just click the link in the show notes to find out a little bit more about the Microfamily Mavericks, and I look forward to potentially seeing you on the inside. So now back to the show.
That's the first critical thing that you need to know about setting up your own bank. Mutual company versus shareholder company. The first thing has to be, you need to be with a mutual company. And there are experts out there who can set up your bank incorrectly, which would be to your detriment. And that's the reason why my wife went and got licensed, so that we could understand this fully and be able to share with others our learnings, so they can leverage our mistakes and not make the same ones that we made.
Just to add on to what you're also saying, Lee, is when you were talking about using that mutual versus shareholders. Why is this important to you? This is important to you because when you when you get a loan, when you request a loan and get loaned money, people will say sometimes, well, I'm still being taxed on that loan. One, yes, you will get taxed on that loan. The tax rate is usually way much lower than if you went into a bank. Like you said, in 4 or 5% versus going into a bank where you might be 7, 8%. Now, when you are taxed, that interest, that means that mutual insurance company is making some kind of profit. But because it's not a shareholder sort of entity, it's more of a mutual. What that means for you is that when a dividend is declared, you also get a part of that dividend. So you are paying that interest for you to get that little portion back to you in the form of a dividend. Whereas when you go to a bank is never going to share its dividends with you, right? So the only people who get to benefit in the dividends are who? The bank, the shareholders, the like, not you, right? The other thing, as we are talking about these loans as well, is that a lot of times people also question, okay, if I go and get this loan, how long does it take? What's the process? How does that work? Now, the wonderful thing about getting this loan from yourself is that, one, there is some paperwork to fill out. And the paperwork is because there has to be a record that, yes, funds have been pulled out of things of that sort. Whereas when you go into a bank, you fill out an application form. And just because you filled out an application form does not mean that you're going to be accepted, or you may be accepted, but then they'll tell you, well, your credit is not as bad as great. So instead of getting 7%, we can give you this money at 10%, right? And it usually doesn't happen in about 24 to 48 hours. Whereas when you do it with your family bank or with your cash value life insurance, usually within 24 to 48 hours, you fill out the paperwork, the money is deposited into your account. So there's all these other benefits that you're really enjoying, unlike if you were to walk into a banking institution to go and request for a loan. Nobody's going to say to you, how are you going to pay it back? You have to pay it back by paying me $1,000 every month for the next 24 months. And if you don't make a payment, I'm going to charge you a penalty for that. When you've done a loan from your cash value life insurance, you determine when and how you want to pay it back. Nobody's going to specify that for you, right? So those are some of the other benefits that keep coming up to just show you that the difference between this concept versus going into a banking institution, there's just all these advantages that you get to really enjoy right now versus saying, well, I'll still stick with going to the bank because the bank will always give me a loan. Yes, they'll always give you a loan, but you have to look at the differences and see in the end, who is benefiting more from this loan even.
Oh yeah. And I actually, because I've taken out, that was one of the main like drawing factors for me taking out a loan from my cash value, was because no one was going to tell me when I needed to make payments.
Yeah.
Like there was not going to be a payment schedule,
Mhm.
because what I was using that money for was buying a value add real estate property. And with value add, if you're in any kind of real estate, you know, it don't cash flow at the beginning. Like there's a lot of money you still need to put into it to help get it to the level where it does start cash flowing. Then maybe you can refinance, pull money out, you know, pay back the loan. But I wanted, so me taking out a loan for my life insurance policy was a cash play, a cash flow play for me. It was a cash flow strategy because it helped me maintain cash flow without having a loan or payment that I had to make. And no one has ever asked me. I've had that loan out for like 2 years now. No one's ever asked me for anything from the life insurance policy. And I plan to pay it back whenever I refinance one of these buildings and I get a lump sum and I'll put it back in there. Because the thing is for everyone to understand is, even if you never pay back the loan, they will just deduct it from the death benefit when you pass on. So yeah, your heirs might get a little bit less, but depending on what your death benefit is, it may just be like a drop in the bucket from what you actually owed. So that is definitely another great strategy when it comes to banking on yourself. The other thing I want to add too, that I think for me, it was also double dipping and making that money work
Yes.
twice as hard,
Yes.
because I put it in the life insurance policy. I went around, turned around, and took a loan from it. But because it's a loan, I'm not withdrawing from my cash value.
Yes.
That money's still in there collecting dividends and still growing with the whatever the market's doing, or wherever this life insurance company does invest that capital. So whatever that investment's happening, I'm getting dividends from it. Plus, I've taken it out and I've invested it again some over here. So it's growing here and it's growing in my policy. So
Arbitrage.
Yeah. Arbitrage, extra arbitrage. So that's another benefit of using a life insurance policy's cash value to help you with your other financial needs. And even like Lee said, if you think of it as a savings plan and you're saving, but I think it's still better than savings because it's not just keeping up with inflation. It's still invested, you're still getting dividends. So it's like you investing I don't want to say stock market, but I guess similar, just to have something that people understand. It's like investing there, but like having that money where you could just pull out without selling your shares. But it's in
Yes.
the life insurance. So yeah, I get it. Okay. I could go on
But
a whole rant.
we can go, and that's the thing about this is when you start having an honest conversation about this and the opportunities that it affords you, that's when you start to get excited about all of this, right? And the conversation has now transitioned onto taking out the loans, but there's also differences that you have to recognize with how the policy is set up. Is there direct recognition versus non-direct recognition, right? Because yeah, we said go with the mutual insurance company, right? But the next layer to this is whether or not if there's direct recognition versus non-direct recognition. So with direct recognition, when you take out the loan, your cash value level is reduced by the amount of the loan, right?
Are you enjoying this episode? Then stop what you're doing right now. Head over to Apple Podcasts and leave us a rating and review. It really helps our show get pushed to more people who are looking for the information that we're sharing here. We have to share the wealth. If you listen to us on YouTube, make sure you like the episode that you're listening to right now and subscribe to our channel. Then share the channel with somebody else. There are people out there looking for the information you're listening to right now. So make sure you share it with someone who you know needs it. Now, back to the show.
So if you have $50,000 and you take out $30,000, your cash value is now going to be at $20,000, right? So that's direct recognition. When you take out the loan, the cash value goes down. But with non-direct recognition, when you take out a loan, if your cash value is at $50,000, it stays at $50,000, right? That gets you excited because you talked about the double dipping play, right? Now I'm earning a dividend on my cash value, right? But I've taken out a loan and I now have it invested in some other investment vehicle. So let's use the analogy that got me excited when I saw your podcast was like, oh, I could turn this into Toro, right? So I could take out $25,000 from my cash value policy and I can put that onto Toro, right? And if I have a paid off vehicle, right, all of the monies that I get from Toro are now just on top of that. I could use that as an arbitrage to pay back the loan, or I could use that money to go and grow my Toro fleet. But that's just one opportunity. And as you mentioned, you took out the loan so that you can buy a value add cash flowing property. There's another arbitrage at the same time. But if you haven't started your own bank, you can't even have that conversation.
Yeah.
Oh.
Right? You're not even having that conversation of arbitrage and how it is that you could actually leverage. But this is one of the reasons why our mission, our passion, and you could probably see that we get excited about this. I don't know why we get excited about this, but this is something to get excited about because banking in and of itself is probably a very boring, stale, dry topic. But once you start to understand this thing, you could get excited about it because then you start to see the opportunities and how you can use it for your family. And that's what matters at the end of the day, is what are you leaving for your family? What kind of legacy are you creating?
Definitely. And go ahead. Sorry, Eunice, go ahead.
One of the other things that I know you had asked and I didn't touch on is the cost, where people say, well, this is more expensive than term and things of that sort. A lot of times when people say that, I usually ask them, so how much do you believe this is? And people will throw numbers at you. And I'm like, okay, how much are you able, or how much falls within your capacity to pay for something like this? And they'll give you a number. And that's what this is all about. It's not about, well, I had Nicole say she's paying $1,500 per month, so it means it's expensive and I can't afford it. It's customized. So we sit down, we have a conversation to understand what your needs are. And a lot of times you find that with some people, they may be also need to rearrange some of the debt that they have so that they can leverage using the policy to even help them pay off debt, right? So there is a customization, there is a process of having those conversations to understand your needs, to understand where you are, and then coming up with a policy that's going to be within your willpower. There's no reason in us having a conversation and saying to you, hey, we want you to get onto a policy and this policy is going to be 1,500 when you know that you can afford 1,000, or when you know that, you know what, instead of 15, maybe I can do 2,500. It's customized to your needs. That way you are able to continue making those payments. And there's so many options. Sometimes people say to me, well, I don't want to pay for the rest of my life. What if I lose a job? Those are things that we can sit down and understand to make sure, okay, if you say to me, hey, I'm working now, but what's going to happen if I lose my job? We reassess, we come back, we look at your policy to see, are we able to move any things around to afford you to be able to either be paid up and still maintain that policy, but not have to continue with premiums because now you've already paid up. Right? So there's so many options available, but of course you're going to miss all of these options if you just don't ask.
Yes, you need the conversation to start, because that's like one thing for me even was I asked that question, with my advisor, and said like, well, at what year, there's a certain time frame where your contributions, your premium payments, and the policy becomes like self-sufficient, and the dividends that it's giving off can pay for its own premium, so you no longer have to contribute to that particular policy. Or maybe you can take that capital you were using and you could go open another policy. Now you can get one for each of your kids or whatever it is. But I start somewhere. Like, have the conversation, even if you think it's expensive, like Eunice said. Ask the advisor, like, what is the, like, this is my amount. Does it make sense for me to start with a lower amount? Like, can I start lower and build up? Because I'm starting nowhere near, I'll tell y'all, I'm paying $500 a month. That's for my policy. I'm sharing that with everybody just to give, like, that was a low amount, right? And I wanted to start with that because that's what I could do and sustain for right now as I'm still building and growing. But I still have room to, like, I won't say invest, to save big chunks of money if I want, without hitting some other limits that you are capped at based on what your income is. So there's other things to think about. And the other thing I'll say about, like, just having the conversation, finding the right people to start this, having the conversation. One thing, like, I started my policy when I found out about it. Like, I read a few books on it. I got obsessed. I started contacting different advisors, and I had conversations with probably like 4 or 5 different people before I decided which one I wanted to go with. I started it before I even bought like my next commercial property. I didn't even have an idea. I didn't have a deal in the works. Like, I had nothing. I had no idea. I just knew I'm gonna need this sometime, and at least I just pull my money back out whenever I need it. I don't know when the opportunity is going to come, but at least let me set it up, because then I know I could just turn right back around and pull my money right back out. That's why it didn't feel stuck to me. Like, when you're paying on your mortgage, or you want to put an extra $20,000 to get your mortgage balance down. Well, good luck getting that back out. Right? So
well, the thing is, the
so
bank
many
has to
things.
make a decision on how much money you can take out of your house if you were
Yeah.
going to do a HELOC or equity loan. The bank gets to make that decision for you. So if you are in a position where you're in between jobs and you want to apply for that equity line, they may tell you no because you don't have a steady source of income to come in. Right. But the thing is, you actually did 2 things that are very beneficial when it comes to these policies. One, you started when you were younger, right? Because all of this is based off the actuarial table.
Actually, no, I started 3 years ago.
Yeah, no, but you were younger.
You
Oh,
were
you're younger than I am 3 years ago. Okay, all right,
Right?
all right, I get you that. I thought, okay, never mind. I
Right?
get. I
But the
was 3
thing
years
is that
younger.
also helps to lock you in, because you can have as many of these policies as you want. Right now in our household, I think we're up to 3 policies. We have policies on our children at the same time. So if you have an insurable interest in a person, and what you want to do is you want to stack these banking concepts, right? Guess what? When you get the policy on the children, it's very, very low, because the chances of a child passing on is very, very low. But this then comes in. You remember how we got excited about the opportunities that we could have around this. We could get excited about whether or not, if we go, our plan is going to be used for our children to go to college versus that 529 plan. But when they're finished with college and we've paid back the loan, that policy will eventually be transitioned over to them, right? So that's something that we could also get excited about, that we can't when we're talking about a Roth IRA or we're talking about a 529 plan.
Okay, guys, don't kill me, but I'm going to have to cut this episode short. So stay tuned for the next episode that airs, and you can hear the rest of our conversation.
Did you love this episode of Share the Wealth Show? Be sure to connect with Nicole by following her on LinkedIn, Instagram, or Facebook. If you picked up any of the gems that were dropped by today's guest, make sure you not only put them in your bag, but if you know of someone who would benefit from this information, don't keep it to yourself. Share the wealth, and make sure to leave us a rating and review. We'll see you for next week's episode. Subscribe so you'll be notified.